and welcome back, everyone. Hope you all had a good little break. Just going to share my screen again. Let's see. Go to slideshow. This is a presentation I haven't done for a while, so I rejiggered everything yesterday afternoon. It's all really fresh and up to the minute, and the idea is to showcase my colleagues' research. We have a really broad team at Morningstar covering individual stocks and mutual funds and exchange traded funds and a lot of other different variations on investing. And so the idea is to kind of look into some of our tools and give an idea of what our analysts are finding to buy or not finding to buy, and just kind of give you a sense of current market conditions based on our team's bottom-up research. So just a quick Morningstar overview. I promise it won't be a commercial, but I remember when I started at Morningstar, which was in 1993. And I remember my mom was like, Morningstar veggie burgers? What? So I was like, Mom, Morningstar is like Consumer Reports for financial information. And I have always thought that that's a good way to explain what we're trying to do, at least in terms of our individual investor research. So we don't have a vested interest in whether someone does their business with Fidelity or Vanguard or Schwab. The idea is just to help people find the right investments given their situations, given their risk tolerance, given how much oversight they care to provide on their portfolios. That's really what we're all trying to do. So we provide information on information for individuals, financial advisors, and institutional investors. The latter two groups are probably a bigger share of our business, or certainly a bigger share of our business in terms of revenue. But individual investors, I think, will always be kind of the heart and soul of Morningstar, and really a motivating force for people like me, just the chance to feel like, we're helping lighten the load a little bit. So we provide research on a lot of different investment types. Mutual funds, of course, were our original product type that we covered. And when I joined Morningstar, I was part of the team focused on mutual fund research, but we have research on exchange traded funds, separate accounts, collective investment trusts, which increasingly are popping up in people's company retirement plans. We do research on 529 college savings plans, health savings accounts. We have an arm that is dedicated to credit research, so researching individual credits. We have a subsidiary that we acquired several years ago called PitchBook that is focused on non-public investments, so venture capital, private equity, and so forth. We have a fairly significant team focused on sustainable/ESG investing. That team is called Sustainalytics. And then the research group that I'm part of is focused on portfolio construction, financial planning, retirement planning. It's a little but mighty group, I like to think. So on our team is we're led by Jeff Patak and John Reckenthaler, Amy Arnott, and I are all on this portfolio research group. In terms of the presentation today, I'll just talk about what I'll go through. I'll touch really lightly on Morningstar's philosophy. I'll get into a 2023 market recap. It was a good year, which was welcome following 2022. I'll delve into US equities because that is the bulk of most of our portfolios, where we're spotting opportunity, where we're not spotting opportunities today. I'll spend some time on non-US equities because I think by many measures, non-US looks attractive relative to US. And I'll share some specific fund ideas there because I think for most of us, that's how we obtain non-US equity exposure, is by using some sort of a mutual fund or exchange traded fund. So I'll share some of our best ideas for people who want to rebalance into non-US. I'm going to spend a little bit of time looking at fixed income. It's really hard to convince people to be interested in fixed income after 2022's route, but certainly, as I touched on in my previous presentation, the raw materials are there for much better returns for bond investors than we had in the previous decade. And certainly for people who are approaching retirement, I think fixed income assets are well worth a look. I'll talk a little bit about inflation and how to address inflation as part of your portfolio plan. And finally, I'll end with a little bit of tax planning thought, some ways to think about enhancing your portfolio's after-tax return. So just a quick overview of how we're thinking about security selection. On the equity side, our team has always been bottom-up focused, so we are not technical analysts. We would never suggest that investors invest that way. I know that there are some AAII investors who are big adherents, and fine, that's just not what we do at Morningstar. We are bottom-up focused. We're focused on valuation. We're like to recommend great companies, but only at what we think are fair prices. So our research is always keenly attuned to valuation. And then we're also partial to a concept called economic moat, that we like to recommend companies that have some sustainable competitive advantages relative to their competitors, something lasting about the business that will give that company a lasting edge. And it's very difficult to build a moat, very difficult to find companies with moats. So it's a fairly small subset of companies that we would define as having wide moats. And many of you are familiar with the concept of moats from Warren Buffett, which is where we really have taken the idea that Buffett believes in exactly that thing, that if you invest in a company that has sort of enduring business advantages, it's a company that you can hold for many, many years, or maybe even hold it forever. So we look hard at this concept of, does this business have a moat, or does its what seems to be an advantage, is it something more ephemeral? So those are kind of the key principles underpinning our equity research. On the fund side, we're also bottom up. So, we're not going to be looking at charts in an effort to help you find the best funds to buy. We look at funds from the bottom up. So we do research on investment firms. We spend time interviewing their managers. We spend a lot of time looking at costs, because what all of our research over the years very much points to the value of keeping costs down with your investment portfolio. Lynn mentioned at the outset of the presentation that I'm head of the John C. Bogle Center for Financial Literacy, which is a group sometimes called the Bogleheads, that is very focused on low-cost investing. It's just a great way to build a portfolio that you can own for many years, and it's the best way to enhance your take-home return, is just to really cheap out in terms of expenses. So our team is keenly attuned to the value of keeping costs low. We're, I would say, kind of agnostic on the index versus active debate. Our research does very much show that the typical active manager hasn't made a great case for him or herself, but in part that's a cost story. So when you winnow down the active fund universe to the low cost subset, well, there you have a fairer fight, and there you start to see active managers make a better case for themselves. We monitor active versus index fund performance, certainly. In fact, we have this active passive barometer research that our ETF team works on every year. And it very much points to, especially in very large liquid categories like US large cap stocks, active managers have a very difficult time distinguishing themselves. But it kind of ebbs and flows based on the specific time period. But over long periods of time, index funds are a pretty good bet. And again, it depends on your category. In terms of portfolios, which is the team that I'm part of, we focus a lot on outcomes. We think a lot about outcomes. So, you sometimes hear about like the optimal portfolio plan. In our view, the optimal portfolio plan is the one that someone can live with and stick with. And so, a portfolio that looks perfectly excellent in a lab, if someone can't stick with it and live with it, if they can't extract their cash flows from it, if they're in retirement, whatever the case might be, it's not the right plan. So we focus a lot on outcomes. We think a lot about outcomes. We also just think about simplification. How can we get a portfolio plan done with the fewest possible moving parts? How can we try to eliminate unnecessary complexity? Those are things that we think about every day. So that's just kind of an overview of our philosophy, how we approach these matters. In terms of this specific presentation, it is sort of red meat sort of presentation where it does have a lot of investment ideas. So I just want to take care to ground them in some ways to think about implementing them as part of your portfolio plan. I think about them not as a call, certainly to upend your existing holdings, but if you're doing some rebalancing or maybe you manage an individual stock portfolio in addition to your main portfolio, these are some ideas that are potentially worthy of sort of further consideration. They might also be helpful in the context of rebalancing. So if you periodically adjust your portfolio's asset allocation and you want to bring forward, say, some non-US stocks or top up your fixed income exposure, or whatever the case might be, these are maybe some building blocks that you could think about as you construct that plan as you undertake that rebalancing. So just a quick view of the past decade. Many of you have seen these quilted type charts that look at asset class returns over various time periods. 2023, you can see in the far right-hand column, and you can see how the various market constituents performed. You can see that Bitcoin had kind of worst to first sort of performance from 2022 to 2023, where it was on the bottom in 2022, shot to the top with like 160% return last year. But what you can see is that there's a lot of variability in this stuff from year to year. Oftentimes it is sort of darkest before the dawn, that the category that performed terribly the year before goes on to have a terrific year in the subsequent year. What you can see is that in many years, the stocks, the blue boxes do tend to be toward the top, that they have many years where they outperform other asset classes. And then you can see other years where they're crummy. So 2022 is a great example of that. But I think this is just a good sort of reinforcing mechanism for humility, that it's very difficult to predict over a short time period what might perform well in the next year or the next couple of years. 2022, I probably don't need to remind anyone that rising interest rates hurt almost everything in that year, where you had stocks and bonds falling simultaneously. Stocks tended to fall a little higher, a little farther than bonds, but nonetheless, it was not an unprecedented year, but it was the type of year we hadn't seen in several decades, where we had both stock prices and bond prices falling at the same time, which is, I think, really underscores the value of holding some cash in your portfolio for ongoing liquidity rather than maintaining a fully invested portfolio. 2023 was very much a reversal, where we saw bonds recover some of their ground from 2022 losses. Stocks enjoyed a very strong run, and commodities were a rare asset class that actually lost money in 2023. But the market lifted most boats, and most of our portfolios enjoyed healthy gains really across the board. In terms of notable pockets of strength in 2023, digital assets, I mentioned crypto, had a great resurgence. Technology sector, after really struggling in 2022, came back strong. That strength in performance, incidentally, has persisted into 2024. U.S. large growth funds, which are heavily populated by some of those technology stocks, enjoyed strong gains. Latin America has been a strong performing part of the world. Consumer cyclical and retail stocks also performed really well. In terms of very weak parts of the market in 2023, even very weak pockets of the market paled in comparison to 2022 losses. So China has continued to be a struggling region of the world, growth falling off significantly. Commodities struggled, as I mentioned. Utilities also struggled in 2023, in part because rising interest rates are a headwind for utilities. Commodities, funds that focus on specific slices of the commodities market, whether energy or metals or whatever the case might be, also struggled. And then some of these trend-focused mutual funds also struggled, some of the thematic type funds, and they vary in their different strategies, but they all had losses. But even these losses, when you compare them to 2022, are fairly modest. So 2023 was a fairly solid year. Chances are you had some winning holdings in your portfolio. The net effect of that, especially for equities, is that the typical stock in our coverage universe is now slightly overvalued. So this is a snapshot of our price to fair value graph, which is available on Morningstar.com. And I'll just explain what we're looking at here. We have a big group of analysts who are covering individual equities, and we ask them to come up with a fair value for the companies in their coverage universe. So we ask them to do discounted cash flow analysis to arrive at what they think a company should be worth. So to use a simple example, maybe they think a company is worth $80 and it's trading at, or maybe a company in their coverage universe, they think it should be worth $100 and it's trading at 80. Well, their price to fair value would be 0.8. If, on the other hand, it's trading at $120 and the analyst thinks it's worth $100, well, there the price to fair value would be 1.2. So we can roll all of these price to fair values up to come up with kind of a rough gauge of, is the market cheap or expensive at any given point in time? And this is a global coverage universe. And what you can see is that this bounces around a little bit. That at the end of December, for example, we were seeing a slight discount to fair value, but more recently, the price to fair value for the whole coverage universe suggests that the typical stock is slightly overvalued today. What we can see, though, is that we can delve into that broad brush assessment. Yes, the market's slightly overvalued. We can look at specific subsegments of the market. So how about if we look at this universe of companies that our analysts think have wide moats, that they think have sustainable business advantages. And so just a short list of companies like that would be Microsoft, BlackRock, Alphabet, Amazon.com, good quality companies that we think have some sustainable edge over their competitors. Well, that universe is trading slightly over fair value in aggregate, that subset of good quality companies with sustainable business advantages. If we look at the narrow moat companies, where the companies have some business advantages. So Lululemon, I think, is a really great example of that, where, yes, you can get people like me to pay $88 for yoga pants, but like if there were some other company that had comparable yoga pants that were maybe the same price, or maybe I just wanted to try a new brand, well, yeah, I'd look at them. They don't really have a lasting competitive advantage. In fact, there's kind of a cottage industry of Amazon of like yoga pants that are like X Lululemon model. So that's a narrow moat company, some business advantages, but not necessarily sustainable. That universe of companies is trading right in line with fair value. And then the no moat companies, those companies that we think don't really have sustainable business advantages, they look relatively cheaper to us today. So Allstate, for example, would be a good example of that. Property casualty insurance is just a super cutthroat industry, right? Where you're going to take a hard look at what you're paying for property insurance. You're going to take a hard look at what you're paying for your auto insurance. And if your neighbor is saying that he's getting a much better deal on his State Farm policy or whatever the case might be, you might consider shopping it around. So that's the type of company we would categorize as having no moat. Well, there are times where sometimes the no moat companies can get inexpensive, and right now it looks like they are slightly less expensive than our broad coverage universe and less expensive than the wide moat companies. Now, some investors might say, well, I want to own a wide moat company and I don't want to monkey around with the no moat companies, which is fine, but this is just kind of food for thought. When we look at small caps today, the cut of companies under coverage that our analysts classify as small caps, we can see that they actually look fairly cheap relative to that broad coverage universe, which is something that I've been seeing corroborated in a lot of different places recently, but it's definitely corroborated in our bottom-up universe. So the subset of companies that we cover that are small companies look the cheapest of any of the capitalization bands today. Large caps look more fully valued, so the price to fair value for that coverage universe is 1.04, and then mid caps kind of fall between the two, which often happens. So they're not quite as expensive looking as the large caps, but not quite as cheap as small caps. So we're starting to form some conclusions that large caps look a little bit expensive, and the narrow and no moats look a little bit cheaper than the wide moats. And so we can also look at our style box through this lens, where we're looking at all of the companies in our coverage universe and apportioning them by our Morningstar style box. And I'll just explain what we're looking at here. This is an attempt to, and apologize for the kind of handcrafted looking graphics. This is like me working last night on pulling data out of our Morningstar Direct software, but this is a grid that is looking at stocks based on their characteristics. So in that upper left-hand column, for example, you've got large cap value stocks. That would be like big energy stocks, big financials, would tend to land in that large cap value square of the style box. So they're big companies, but they're trading at a discount and they have other attributes that make them more like value companies. In the middle, we've got core or blend type companies. And on the right-hand side, you've got growth companies, and you've got the large ones on the top, the mid-sized ones in the middle, and the small-sized ones on the bottom. And so you can come away with some conclusions about price to fair values of these various market subsegments. So what we're seeing here is some corroboration that value looks inexpensive to us. So sort of the traditionally defined value companies are trading at a nice discount to fair value currently. Growth, not so much, right? You see overvaluation in the large cap growth square with the 1.08 and in the mid cap growth square. And the core type companies, the blend type companies, kind of in the middle. And so those would be companies that blend value and growth attributes. So the big pharmaceuticals would tend to land in large cap core, for example, where they're not way over with the metas and the apples of the world in the growth column, but they have some growth attributes as well. So it's just some food for thought. I think if you're thinking about repositioning your portfolio or rebalancing, our research would suggest that tilting away from growth, even though it seems like there's a lot of momentum behind those names, tilting a little bit more toward value would be a reasonable thing to be thinking about if you're thinking about kind of bottom up price to fair values. I just wanted to point out, I had a slide. I was updating these slides. I had last given this presentation in October 2022. I was struck by how much things have changed in terms of these price to fair values then versus now. And in late 2022, you may remember the worst was kind of over with the equity market losses. And so stocks really across the board, growth, value, small, large, everything looked pretty cheap to us at that point. Now things have shifted where value still looks inexpensive to us, but growth has actually become overvalued, certainly mid and large cap growth. So I just wanted to underscore that things have changed fairly significantly since the end of the year in 2022 when I last did this presentation. Any questions so far? Okay.
Yes, there are questions.
Okay. Okay. Let's tackle some questions if that's okay.
Okay. I have a question. Oh no, that's for the local. Do you have this one's strange. Do you have help in launching an ETF?
Hmm. I don't know what that means. I
It
don't have
sounds
an
like they're
ETF.
trying to create an ETF. I don't understand that.
Oh, do we offer help with that? No, I don't think we would.
Okay. Um, and the one comment was just as you started, do you mean 2024 and beyond?
Yes. What did it say?
It
I
was
can't
just
remember.
as I I I don't have the context. I'm
Okay.
sorry.
Okay. Maybe my title slide was wrong, but yes, this is all for 2024 and beyond.
Okay, and there are asterisks on slide 17. What do they mean?
Yeah, thank you for that question. So I should have mentioned, and I'm glad you called attention to it, just that the number of companies under coverage in these small cap bands are not that many. Whereas, there are thousands of small cap companies, and we do not cover the bulk of them. So I would hate for someone to take it to the bank that small caps are cheap based on our research. I think that there are some data to suggest that's the case, but just that by the time I look at the companies that we have under coverage, it's just not, I don't think it's inclusive enough to say based on this data point alone that small caps look cheap. So just wanted to make that point, and I'm glad that that question called it out.
What about REITs?
So REITs would tend to fall in the small cap value square of the style box, and that actually lends itself well to this slide, which looks at the price to fair values based on sector. And this is another one where I was updating this slide from 1022 from October 2022, and just a huge reversal because almost everything looked cheap when I gave that presentation. This one is just a big ho hum, but I will say real estate is one category that, based on our analysts' REITs under coverage, would suggest that they think that there's some upside there, that the typical REIT uh, in our coverage universe is like at a 10% discount to fair value. So that's where those land today. But this is just a sector view. You can see that technology stocks, for example, appear to be a bit ahead of themselves based on our bottom-up research. But just some food for thought here.
Okay, there were a couple questions for the local for us, and that looks like the only that looks like the questions. Thank you.
Okay. So how do we sort of translate this into specific stock picks? Well, one screen that I like to run using our data, using our analyst ratings, would be to look at companies that have 4 or 5 stars. So these are individual equities that our analysts believe are trading cheaply relative to their fair values. That's what the equity star rating is. That have wide moats, so they're what we think are superior businesses, and have what we consider low uncertainty ratings. So not only do we think a company's cheap, but we also think that we're fairly sure that it's cheap because it's fairly easy for us to predict its future cash flows. So the example I always give in this context would be like the consumer staples area, where we have a really long tenured analyst on like the Procter and Gamble's of the world. And those are companies that tend to have sort of persistently low uncertainty ratings because it's fairly easy to predict their cash flows. The demand for Pampers and Tide detergent and stuff like that just doesn't bounce around that much. So our analyst there, Aaron Lash, is able to say at any given point in time, well, I have a lot of visibility into what this company's future cash flows are apt to look like. And so right now, I think it's cheap or expensive or whatever the case might be. So this is just a short list. The size of this list kind of bounces around based on market environment. since the market has elevated fairly nicely through 2023 and into 2024, this list has shrunk significantly from when I did this presentation in late 2022. But this is just a short list of high quality, probably pretty familiar companies in most cases to you, that would be worthy of further research if you are, kind of looking for something that's still a bit undervalued and a good quality company with what we think is fairly low risk. If we are willing to look at a subset of companies with similar attributes, so again, screening our database for companies with 4 or 5 stars, so, well, in this case, 5 stars, low market valuations, wide moats, and medium uncertainty ratings. So we're maybe willing to tolerate a little bit more variability in cash flows. You can come up with a longer list, maybe not quite as high quality list of companies, fair number of pharmaceuticals on this list. Some of the consumer staples companies are here as well. But these are companies where we feel like we have a little bit less visibility into their future earnings, which is why they have these medium uncertainty ratings. I'll just pause here and say that anyone who wants these slides, I think we will make them available, and they're also recording this presentation. So if you're feverishly scribbling down these names, you don't have to do that. We could make the slides available to you. And I did a little bit of a market capitalization cutoff when I was running the data. I actually had a longer list than I wanted or needed. So I lopped off some of the smaller cap, not necessarily smaller cap, but some of the mid-sized companies that might be less familiar, and focused on the large caps for the purpose of this particular slide. In terms of how this might translate if you're a fund investor, if you're not really an individual equity investor, I think as we sort of look at a fairly valued market, which is what the previous slide showed, I think you'd want to kind of think about emphasizing, if I have funds in my portfolio, how do I tilt a little bit toward that value side of the style box? How do I make sure that I have valuation conscious funds in my portfolio? I think I'd want to be careful about tilting heavily toward that sort of top right hand corner of the style box, the large growth style funds, because they have had such a strong run, and of course that momentum might continue. But I think if you want to kind of grade things a little bit more toward the value side of the style box, that makes sense. So I just pulled a short list of funds and exchange traded funds that our analysts like, that do focus on valuation and quality, so in line with kind of that moat concept. Some of them have a dividend focus. I really like a dividend growth style fund. These are funds that don't prioritize current dividends, but instead prioritize companies that have been able to grow their dividends over a period of years. The benefit of that strategy, and the reason I like it, is that it tends to be kind of a higher quality cut of the broad market. What we saw in a year like 2022, for example, was that the dividend growth strategies held up very, very well, because they tend to kind of underplay the technology sector. They tend to emphasize some of those stable growers, and they vindicate themselves well in down markets. Really like a dividend growth strategy for people who are in retirement, who, excuse me, want to have equities in their portfolio, but are worried about the volatility that can accompany equities. So I have a couple of dividend growth strategies in this slide. And then finally, a pure high dividend yield index, Vanguard's fund and ETF pair, I think are very solid in terms of prioritizing currently high dividends. So for people who like that bird in the hand, that is a good fund to consider. If you are looking at your portfolio, and by the way, I would say this is a great time, if you haven't done so in a year or two, to just look at your portfolio's positioning in our style box. We have some functionality called X-ray that enables you to actually peer into your holdings. So it's not just taking, say, a large cap value fund and putting it all in the large cap value box. It actually looks at the constituent holdings of that fund. And it might say, well, actually, some of that large cap value funds holdings are actually in blend or in mid cap value or whatever the case might be. You can plug your holdings into that portfolio manager tool and see what the composition of the underlying holdings looks like. So if you've kind of run through this, you may find that your portfolio is light on small and mid caps because large caps have had such a good run. So this is a short list of small and mid cap funds that our analyst team likes. So these are all funds that receive medalist ratings from our analyst team. So many people are familiar with our star rating, which is just a backward looking view of how a fund has balanced risk and return in the past. These medalist ratings are meant to look forward. So they're meant to factor in things like the fund's expense ratio and the stability of the management team and the soundness of the strategy. So we rate funds as gold, silver, bronze, neutral, or negative. These funds are all medalists, meaning they receive mainly gold and silver ratings. There might be a few bronze on the list as well. Again, a combination of active funds and passively managed funds, kind of depending on whatever is your main philosophy. Our team thinks that you can find decent representatives of both fund types. Shifting over to discuss valuations overseas, valuations do look better to our team overseas. So this is a slide I pulled from our Morningstar Investment Management team where they do these 10-year capital markets forecasts where they attempt to come up with a 10-year forecast of what an asset class should likely return over that 10-year period. And so for equities, they're looking at where dividend yields are. They're looking at their expectation of price earnings multiple expansion or contraction. They're also looking at earnings growth for equities. For fixed income, as I mentioned in the previous presentation, there's a pretty tight connection between starting fixed income yields and what the total return should be over the subsequent decade. So that's what they use for fixed income. So you can see that the highest bars here are belonging to international equities, both international developed markets stocks and international emerging market stocks, that our team is expecting much better things than from US stocks. So US stocks are down in the sub 5% range, and this is nominal, this is not inflation adjusted, whereas the non-US components are significantly healthier. So that's an interesting finding. And what you can see is when you look at this across different investment firms, and this is something that I pull as part of this capital markets forecast compendium, you can see that different firms generally are in agreement that non-US stocks should outperform US over the next decade. And that's largely a valuation story, that starting valuations are lower on non-US than is the case in the US. And that's the key reason why all these different firms are expecting better returns from non-US. I will say I've been compiling this forecast for a couple of years, or at least a couple of years, and this has been kind of a persistent theme that non-US is cheap. And with the exception of, I think maybe we saw a little bit of a reversal in 2022, but it really hasn't come to fruition, this thesis that non-US will outperform. But nonetheless, valuations suggest that eventually that will be the case. Just a quick look at this based on a couple of firms' outlooks. BlackRock, for example, its forecast for non-US almost twice as high. For European large caps, for example, relative to US large caps. Research affiliates, definitely twice as high for non-US versus US. And Vanguard, not quite as pessimistic for U.S. relative to non-U.S., but nonetheless expecting to see a performance edge in non-U.S. So pretty consistent theme here, and I think the call to action would be if you haven't rebalanced your portfolio to non-US, maybe it's a reasonable time to consider doing so. When we look at this on a bottom-up basis, when I look at the companies in our coverage universe that are US versus non-US, I see confirmation of the cheapness. So the price to fair value for the typical US company in our coverage universe, or the median price to fair value is 0.97 versus 0.89 for non-US. And dividend yields are also higher outside the US. So over 3% non-US, just over 2% for US. So a couple takeaways. Lower starting valuations suggest better returns from non-US stocks than US over the next decade. Our research really points to both developed and emerging markets as likely to outperform the US over the next decade. This is kind of ebbed and flowed. There have been points in time where our team has thought emerging markets were notably cheap. Right now, it does look like they're expecting slightly better return prospects from emerging than developed, but both are significantly ahead of the US return prospects. So if you're just doing, you don't need to be tactical or anything. Don't need to be too active in terms of your asset allocation. But if you're just doing simple rebalancing, it's very likely that your portfolio, if you've just been letting it ride, that your portfolio's non-US components have been drifting lower. And that's an area to consider rebalancing into. So a few ideas for international fund investors. And maybe I should just pause there and see if there are any questions about the non-US sort of findings.
Yes, there are. Do you consider
Okay.
political tensions with other countries when looking at foreign stocks?
Yeah, so really important question, but I would say in general, our team does not factor them into certainly doesn't factor into the bottom up forecasts. So that's certainly a consideration. And, arguably a reason that emerging markets should trade at a persistent undervaluation relative to developed markets, simply because you have just the possibility of these geopolitical risks that don't exist as much for the US, where you have a government being overthrown or a currency, totally devalued overnight, whatever, these things that can pop up for emerging markets. So it's not factored explicitly into our analysis. And I think that, the onus is on each of us to kind of factor them in as we approach these things.
Any specific thoughts on India? Lots of analysts seem to be bullish on India and China.
I don't really have, I would say that this takes me a little out of my comfort zone, so I can't really speak to that. Unfortunately, sorry about that.
You suggest any particular country for non-US?
Well, so my biases would be showing, which is I would tend to not be too fancy in terms of trying to focus on any one specific region or certainly country. I would tend to approach this a little bit more broadly, certainly with my own portfolio, just because I like to be pretty hands-off with my portfolio. So I just can't point to any one specific country. I would generally urge investors to go in with broad market funds. If you want to cut it a little bit more finely, maybe you have developed and developing, sort of specific funds geared toward each. But for my own portfolio, I like to keep things pretty basic. I have been shading our portfolio a little bit toward international value. So every year when my husband and I make our IRA contributions, we make a contribution to an international value fund. Hasn't quite worked out in our favor just yet, but it may eventually. But my bias is more toward, the broad building blocks versus the more finely tuned exposures.
It, it is suggested that non-US returns are better, but also the currency risk can affect volatility. how does one hedge that aspect?
Well, so there are ETFs that are hedged into the dollar. So that's one possibility where you're basically getting the foreign stock performance without the currency related volatility. But I would say it's also pretty hard to run away from currency volatility altogether because these companies have currency exposures as well. So it's a little bit of a Rubik's cube, but using a hedged uh, uh, product would be one way to have foreign stock exposure that is hedged into the US dollar, where you're basically saying, I don't want the non-US currency fluctuations to really affect my return at all. So that's one possible idea.
Are you hearing anything about Russian markets equities?
I'm not. They've not been a great place to invest. So no, and I will say I just am not an expert in that area. So I hesitate to say much more, although I did study Russian language for 10 years. So I pay attention to what's going on in Russia, and unfortunately I'm very sad about the turn of events, but I have nothing to say about the investing opportunities.
Does Morningstar think GLP-1 drugs will impact food and beverage stocks?
Yes. We have a team of analysts covering healthcare stocks. And I recently had a hallway conversation with our long tenured analyst. And he said that the drugs, so the Ozempics and so forth, are kind of like the AI of his world, where they're really upending everything that they think about all of these other companies. So I think they think that there will be implications for food and beverage stocks and certainly other pharmaceutical stocks. Like if ideally weight loss helps people get away from some of these other cardiovascular conditions, lessens the risk of diabetes and so forth, that would lessen the franchises of some of these other pharmaceutical makers. So I think it's very much factoring into their thinking. I think they're thinking about the broad implications very deeply.
Um, is the there's concern that Morningstar has discontinued the X-ray feature. Is it still available?
I think it is. So I think that we had a tool called Instant X-ray that I think is unavailable. What still works, as far as I can tell, is if you have a portfolio saved in our portfolio manager tool, I think you should be able to click on X-ray within the portfolio manager and see an X-ray of your portfolio. But email me if you have trouble with that, and I'll try to help you. But I think that should be working. But that instant X-ray, unfortunately, I used to refer to it all the time and thought it was such a great tool. I think that one has been disabled for whatever reason, sadly.
Should you hold dividend stocks in your Roth IRA, which would be tax-free?
So I guess it depends on what you're doing, you know. So potentially, but it depends on sort of where you are in your spending trajectory. Um, so I guess the point with the Roth is like, I'm not sure. I would hesitate to say that as a blanket piece of advice. I would get some tax advice. But a Roth is, where I think about holding my highest returning parts of my portfolio.
Um, I'm looking at the questions. Thoughts on US versus international fixed income?
Oh, good question. I am less enthused about non-US fixed income than I am non-US equities, mainly because I really do favor the hedged versions of non-US fixed income, mainly because if you're in something unhedged that's fully exposed to the currency vagaries of some other country, you end up with something that acts a lot more equity-like than bond-like, which is one reason why I like the hedged products. But by the time you remove the currency fluctuations, I feel like are getting a performance pattern that is not that unlike US bonds. You're usually paying a little bit more for it. So I'm just not, I think it's fine. to hold some non-US fixed income, but I see it as less of a must-have as non-US equity.
Is a Morningstar investor subscriber have access to Morningstar Direct?
Good questions, and the answer is no. So Morningstar Direct is our institutional software program that is, it costs a lot to subscribe, like thousands of dollars per seat. So no, that is not the same thing.
Okay. I think that's the questions.
Okay, good. So everyone's gotten a look at my core foreign stock list. Again, a combination of index and active funds, some ETFs here. I think it just depends on your personal disposition. This Vanguard International Value is the one that I mentioned that my husband and I have been adding to over the years. We are generally Vanguard investors, and it's just a good kind of actively managed, but cheap, actively managed fund that focuses on value stocks. If you are looking at those tantalizing return prospects for emerging markets, this is just a short list of funds that I believe are still open, that are medalist rated funds. So our analysts think their forward-looking prospects are good. And again, a combination of index products and active products here. My personal bias is to just own a broad foreign stock fund with the purview to invest in emerging markets, but I do own American Funds New World in Morningstar's 401k, which is kind of a interesting fund in that it owns companies that benefit indirectly from growth in emerging markets, as well as emerging market stocks, as well as, I believe, some fixed income investments. I want to just touch lightly on bonds. I know we spent some time on bonds in the previous presentations, but previous presentation, but just want to underscore that return expectations have gotten a lot better since yields have gotten higher. But nonetheless, I think if inflation runs higher than perhaps people are expecting, if the Fed doesn't cut in the second half of the year, I think is widely assumed by many bond market participants, I think there could be some volatility in the bond market. So that's one reason why I like this bucket approach of holding cash to meet very near-term cash outlays rather than maintaining a fully invested portfolio at all times. I would also say, if you're using credit sensitive bonds in your portfolio, whether bank loans or high yield bonds, you'd want to think of them as kind of aggressive kickers for your bond portfolio rather than being the whole bond portfolio. You want to think about high quality fixed income because it really does tend to be ballast in most equity market shocks, notwithstanding 2022 when high quality bonds didn't really do that. But in many, many equity market shocks, we've seen strong performance from high quality bonds. So this is just a slide I wanted to share from some forthcoming research that I'm working on with a couple of teammates. Some of you may have seen things like this before. This is a correlation matrix that looks at the correlations of various assets with US stocks. So the US market is that top box. That's our broad Morningstar US Market Index, equity index. And then below it, you can see that the correlations that various assets have had with the US market over the past 20 years. So negative is good, orange is good from the standpoint of building a diversified portfolio because orange indicates that the investment type has behaved in a different way than US stocks. So if you've got US stocks as your main building block in your portfolio and you want to add some additional holding, well, you're looking for performance that is not like US stocks. So Bitcoin, you can see too early to tell. We don't have 20 years worth of data there. But for these other categories, we do. And the interesting takeaway when you look at this slide is just that simple gets it done very nicely. So you look at that 10-year treasury, where you see that the negative correlation over the past 20 years. And then cash. plain old cash, also having a negative correlation over the past 20 years. So just some food for thought as you think about putting together your portfolio. But at the outset, I mentioned that simple is good, that we like simple. Well, this is why, because of the ability to diversify with just treasury bonds and cash, which is, I think, a call to not overcomplicate. And then, uh, on the slide, you also see that there are categories that don't do an especially great job. So REITs, for example, over the 20-year period, actually, this looks okay, but we've seen that correlation increase quite substantially over the past decade or so. So just some kind of food for thought as you're thinking about your portfolio. Here is just a short list of bond funds that our analyst team likes. Again, a mix of active and passively managed funds. I like the idea of, if I'm holding bonds in my portfolio, holding high quality intermediate term, maybe as my main fixed income, some high quality short term, and then cash for those very short time horizons. Inflation, just a quick note, and I touched on this in the previous presentation, where you want to certainly think about it with respect to your plan. You want to make sure that your portfolio has some insulation against inflation. Stocks are the best really way to have sort of a long run sort of way to outrun inflation. But if you're someone who has fixed income investments, you'd want to think about having treasury inflation protected securities and I bonds. Just a couple thoughts on tax efficiency. I spend a lot of time on tax efficiency in my day-to-day work. And so the reason I like talking about tax efficiency so much is just that it's a great way to exert some level of control over your portfolio. So for your taxable portfolio, really thinking about uh, uh, what you're holding in your taxable account, and what you're holding in your tax sheltered accounts. Something called asset location is super important. Thinking about Roth accounts, thinking about conversions can often be an opportune time in the years right after retirement, but before required minimum distributions begin, to consider a series of conversions when you're in a fairly low tax rate, perhaps relative to what you'll be later in retirement. If you're someone who's still in accumulation mode, you can consider these what are called backdoor Roth contribution and conversions, where you're making contributions to a traditional tax deferred IRA and then periodically converting to Roth, which is a way to get money into the Roth column. And then finally, I don't know anyone who focuses on tax matters who doesn't love health savings accounts. So if you're someone who is covered by a high deductible healthcare plan and you're able to contribute to an HSA and you can afford to leave your HSA and not spend from it, that can be a phenomenal strategy to build money up. The HSA is triple tax advantaged, which is the only account type that where you're able to put pre-tax contributions in and enjoy tax-free compounding and then tax-free withdrawals for qualified healthcare expenses. So that's all I've got, just some links here at the end of various things that I've referenced. The investor website, the fair value graph that I used as kind of the launch pad for this discussion, this Markets Observer publication that we put out is such a great resource. We put it out quarterly. It's just a compendium of what I think are super helpful charts. And then that article that references various firms' capital markets forecasts. So I think we're kind of running out of time here, right? But
Well, we can take a few minutes if you have it for the questions.
sure. I will just,
One question was to put back up the bond um, slide so
okay,
that it went by too fast for them to.
okay. So let's see,
Wasn't too far back.
this one maybe.
I think so.
Okay,
They'll let me know if it isn't.
okay.
Overall, your recommendation of US to foreign ratio?
Well, so you could think about the global market cap as a starting point, and I think that's a good starting point for like people under 50. So I think it's about 55 US, 45 non-US, might be 60/40. That's pretty good starting point. And then as you get, I think in retirement, I think a better benchmark might be like 25 to 30% non-US.
You had a list of ETFs for non-US markets. I think that was for stocks, wasn't it?
Yes, should we go back there?
Well, they're asking if you have a similar list of ETFs for US markets.
Well, this is the one that we showed earlier, which would be, I showed this list of kind of quality valuation conscious funds that we like. I would say that's kind of the companion. Since the US market isn't as broadly undervalued as non-US, this is a maybe a little bit more selective list that
Um,
that shades away from the, very high growth stocks that have performed best here in the US.
they just put up a question about the numbers on the horizontal axis on the previous slide. And I don't have a number of the slide.
Hmm. I don't know. Was it this one? These are years.
Uh, they just put it up at 11:38, so it would have been one of the last slides.
This one? No. This one,
Maybe
maybe.
that one would be my.
Yeah. So the way to look at this really is to look, each of these boxes shows you the correlation that the asset has with the other asset on that line. So let's look at like line 8, Morningstar 10-year US Treasury relative to 3. So that is US Treasury, that the 0.24 is, we're going to find 3, which is the price of gold. So what we can see is that treasuries and gold have some correlation, but not a high correlation of 0.24. So you're matching the horizontal line with the number that corresponds with it, if that makes sense. That's what each of these boxes is.
In the 60/40 balanced portfolio, what percentage does cash short term fall into?
I think in most, in 60/40, I guess depends on it's in the eye of the beholder, but the way I would define it is that it's fully invested, sort of a US aggregate bond, US total market, or US S&P 500 is, I think, the conventional understanding of 60/40, not any cash. Whereas I would argue that most retirees especially should have some cash as a component of their portfolio.
And the question, how would you use slide 31?
Is that this one? I can't see,
Yes.
my numbers are cut off. Okay.
Oh, yes.
I would use it when I'm thinking about, if I'm adding things to my portfolio, thinking about, well, if I'm adding this mainly because I think it's going to diversify, I'd use this as a check about, how much to expect it to diversify. So this to me does show that it doesn't take much to diversify, and the diversifiers are pretty plain vanilla, right? So like commodities, for example, are often held out as a good diversifier. And I think that, inflation might be one reason to hold some commodities to kind of hedge against inflation, but as a way to diversify a portfolio is not really jumping out at me as a benefit. Gold, on the other hand, with some correlation to US equities, that 0.07 is something, that looks a little bit more compelling. And then the orange boxes are ones that definitely look compelling. So if I'm adding like second and third holdings in addition to my US equities, this suggests that your second and third holdings should be cash and should be high quality US bonds.
Lynn, you want to handle the question on getting the slides?
Uh, okay, if you want to get the slides, just go to the Silicon Valley Yahoo and ask me, and I'll send them to you. second comment is they moved the dots on the chat line. If you look at your chat meeting, the dots are now in the upper right-hand corner. If you click on that, it says save chat. So
Well, that's for
why
you on a Mac. For me
I'm
on
not
a
sure. Go ahead.
on a PC, it's at the lower. It's at the bottom of the screen.
Okay. Well, I
So
use both PCs and Macs, so
don't agree with each other.
we
Yes,
don't agree with each other. That's true.
I. There was a question about please review paid subscriber services from Morningstar.
I'm not sure what that means, but if they want to drop me a note, they should do that and I can pass it on to the right person.
Okay, because you can get some of the basics from many libraries, but it's limited.
Yeah, good piece of advice, actually. That library service is pretty neat if you want to read the analyst reports or something like that, and you don't necessarily want to be a paid subscriber. The public library may have a library version of our paid Morningstar services.
It is restricted, but it's a nice.
It's very useful, and just check your local library because many of you, the library's already paid for this type of service, and it has some very useful Morningstar information there.
It will
And you've
not have
paid for it through your taxes, so
Yeah, you've already paid for
the
it.
library.
Yeah, it will not have the portfolio or the X-ray feature. So
Right. And you certainly can't save a portfolio on the library version. If you want to save your portfolio and refer back to it, that functionality wouldn't be there.
so I think we've covered the questions. Lynn, do you want to wrap up?
Yes, Christine, thank you very much. Terrific presentation. You have great slides. You always have had, so that's just the standard you set. And we are very appreciative of your time and energy and wisdom. So thank you. And to all who've attended, it's been a great main event. And we thank you for, especially those in the various chapters that support activities and putting on programs like the ones that Christine Benz puts on. So thank you, everybody. Have a
Thank
great
you.
and